Now that you have a solid understanding of the rules and theory behind accounting from Chapter 1, it's time to apply that knowledge to the accounting process. You may remember many of these concepts from your previous accounting classes. If they slipped your mind, don't worry. Subsequent to this week, we will dive into each of these financial statement elements in more detail. This week's material will serve as a thorough review of the accounting process. The focus of this chapter will be guided by the embedded lecture with content covering the way in which business transactions affect a company's accounting records. You will have a review of posting journal entries to the general ledger, preparing the 4 financial statements, and completing the accounting cycle based on the information given about transactions for a specific company. One of the major differences between this chapter and the time you first learned the accounting process in a previous class is the level of detail the transactions will go into. This will be true for the duration of this 2-part series of intermediate accounting. Intermediate accounting offers a practitioner's review using a preparer's approach to understanding business transactions and their financial statement impact. Economic events, whether it be buying inventory, paying employees, or collecting money from customers, cause changes in the financial position of a company. These are created by either external or internal events. External events are events that are defined as involving an exchange transaction with another entity, whereas internal events, like paying customers, do not involve exchange transactions with another entity. As these economic events ebb and flow, it is through double entry accounting that we impact the financial position of the company. Under double entry accounting, every entry must balance, every entry must have a debit and credit, and every entry impacts both sides of the accounting equation. The accounting equation is defined as assets equal liabilities plus owner's equity. We can see this represented by a T account where debits are on the left and credits are on the right. Increases to all assets and expense accounts are debits and occur on the left-hand side of the account, whereas increases to all liability, equity, and revenue accounts are credits and occur on the right side of the account. The accounting equation underlines the process used to capture the effect of economic events. The accounting equation portrays the equality between the total economic resources of an entity, its assets shown on the left side of the equation, and the total claims against the entity represented as liabilities and owner's equity on the right side. The equation also implies that each economic event affecting this equation will have a dual effect because resources must always equal claims. As we move deeper into intermediate accounting, you'll hear me often state that financial statements have a relational impact on each other. For example, if we start at the bottom, net income is represented on the income statement, and ultimately net income feeds into the statement of retained earnings. That final retained earnings balance feeds into the statement of stockholders' equity. And then that final statement of the stockholders' equity balance feeds into our balance sheet as the total of the stockholders' equity. Since owners of the corporation are shareholders, the owner's equity for a corporation is also referred to as shareholders' equity. Shareholders' equity or stockholders' equity for a corporation arises primarily from 2 sources: amounts invested by stockholders in the corporation and amounts earned by the corporation on behalf of its shareholders. These are reported as paid-in capital and retained earnings, respectively. Retained earnings, as you can see represented in the visualization, are calculated as net income less distribution to owners, which is primarily dividends since the inception of the corporation. By the end of intermediate accounting, debits and credits will be second nature to you. In the interim, I'd offer you perhaps a helpful tip to help you remember whether or not you should debit or credit a respective account based on an economic event. If you look at the 5 fingers of your hand, you just so happen to hopefully have all 5 fingers. And so, if you take assets as your first debit, so ALERE, it is the last 2 fingers, your thumb and your pinky, that represent natural debits. So, when you want to increase an asset or an expense account, you're going to debit that account, and everything else by default will be naturally increased by a credit. This brings us to the introduction of general ledger accounts and the differentiation between permanent or real accounts and temporary or nominal accounts. A permanent account represents one of the basic financial position elements: assets, liabilities, or shareholders or stockholders' equity. Whereas temporary accounts represent changes in the retained earnings component of shareholders' equity caused by changes in revenue, expense, gain, or loss transactions. These balances are deemed temporary or nominal as these balances are closed or zeroed out during the accounting closing process. This brings us to an overview of the accounting process cycle. In the subsequent slides, we will review each step in detail. The first step in the process is to identify external transactions impacting the accounting equation, and accounting typically does not witness all business transactions. Therefore, a mechanism is needed to relay this essential information about each transaction to the account. Source documents perform this function, including sales invoices, bills from suppliers, and cash register tapes. These source documents usually identify the date and nature of each transaction, the participating party, and the monetary terms. With this information, the second step in the processing cycle is transactional analysis. Transactional analysis is the process of reviewing the source documents to determine the dual effect on the accounting equation and the specific accounts that will be used to classify the items of analysis. The third step in the process is to record the transaction in the journal. Journals provide a chronological record of all economic events impacting the company. Each journal entry is expressed in terms of equal debits and credits to the account affected by the transaction being recorded. Debits and credits represent increases and decreases to specific accounts, depending on the account type as explained earlier. Step 4 in the processing cycle is to transfer a posted debit and credit information from the journal to the general ledger account. In this illustration, a check is received and a customer has paid $5,000 due on account. The journal entry would be as follows. So, cash needs to increase. Cash is an asset account, so cash will be debited for $5,000, and accounts receivable, which is basically a customer IOU, will be decreased based on that payment. So therefore, accounts receivable will be credited as an asset account to decrease that balance. Now, to take that entry and post it to the respective accounts cash and accounts receivable, we will take that positive cash impact of $5,000, and we will debit that to post it to the T account on the left-hand side. And then accounts receivable will post that credit on the right side of the account. Now, if this were in a business context where we had multiple entries, we would also contain some type of reference. So, whether that's a journal entry number reference, or perhaps sometimes you see alphanumeric references, and therefore we would see that noted in the T account right next to the $5,000. Step 5 involves the preparation of an unadjusted trial balance, which is required before the preparation of the financial statements and before adjusting journal entries or internal transactions are recorded at the end of the accounting period. The trial balance is simply a list of all general ledger accounts, along with their balances at a particular date, listed in the order they appear on the general ledger. The purpose of the trial balance is to allow us to check the completeness and to verify that the sum of the accounts with debit balances equals the sum of the accounts with credit balances. The fact that the debits and credits are equal, though, does not necessarily ensure that all balances are correct. The trial balance could contain offsetting errors. As we'll see later in the chapter, this trial balance will help us prepare to adjust journal entries. Step 6 in the processing cycle is to record in the general ledger and post to the ledger accounts for the effect of internal events. These transactions do not involve an exchange with another party and therefore are not initiated by a source document. They are recorded at the end of this cycle when accounting financial statements are prepared. These transactions are commonly referred to as adjusting journal entries. Adjusting entries are required to implement the accrual basis of accounting. More specifically, these entries help ensure that all revenues are recognized in the period in which goods and services are transferred to customers, regardless of when cash is received, and all expenses are recognized in the period incurred, regardless of when cash is paid. There are a multitude of adjusting journal entries that are offered as examples in the chapter. Prepayments occur when the cash flow proceeds, either the expense or revenue recognition. For example, a company may buy supplies in one period but use them in a later period. Prepaid expenses represent the cost of assets acquired in one period and expenses in a future period. For example, payment may be made by a company for insurance for future periods and represents an asset to the company called prepaid insurance. This asset is expensed in future periods when the use expires. Deferred revenues are created when a company receives cash from a customer in one period for goods or services to be provided in a future period. The cash receipt, which is an external transaction, is recorded as a debit to cash and a credit to a liability called deferred or unearned revenue. This liability reflects the company's obligation to provide goods or services in the future. Accruals involve transactions where cash flow or inflow takes place in a period subsequent to the expense or revenue recognition. After the adjusting journal entries are posted to the general ledger accounts, the next step in the process is Step 7, which is to prepare the adjusted trial balance. The term adjusted refers to the fact that adjusting journal entries have now been posted to these accounts, and then we can begin the preparation of financial statements. The purpose of each of the steps in the processing cycle to this point is to provide information for Step 8, the preparation of financial statements. The adjusted trial balance contains all the necessary information. Statements are the primary means of communicating financial information to external parties. The sequence of events matters in financial statement preparation. We begin with the income statement, due to that relational impact that net income or pessimistically net loss will feed into the statement of retained earnings. That final statement of retained earnings balance will feed into the balance sheet for stockholders' equity. And then, ultimately, it's the ending cash balance that represents that reconciliation on the statement of cash flows. Now, keep in mind, in subsequent chapters, we will dive into each one of these financial statements in more detail. The final two steps in the accounting process cycle are the closing of temporary accounts in Step 9 and the preparation of the post-closing trial balance in Step 10. The closing process serves a dual purpose. The temporary accounts, revenue, expenses, gains, losses, and dividends, are all reduced to zero, ready to measure the activity for the next accounting period. And two, these temporary account balances are closed or transferred to retained earnings to reflect the changes that have occurred during the accounting period. The income summary account is sometimes used as a bookkeeping convenience that provides a check that all temporary accounts have been closed. In other cases, you'll see that the accounts are closed directly to retained earnings. Finally, we've reached Step 10, preparing a post-closing trial balance. This is prepared only at year-end to verify that all closing entries were prepared and posted correctly. The post-closing trial balance is a list of all accounts and their balances after the closing entries have been journalized and posted to the ledger. The post-closing trial balance is a list of all accounts, specifically the permanent and real accounts that still have balances after the closing entries have been made.